Hello, everyone. It's a real treat to be with you all again and to see so many friendly faces from past meetings. Today's session is this next session is one that is an experiment. And we want your feedback, and if it works, we'd like to repeat it again. The observation is that since you all formed the Sustainable Banking Network, this has gone from a new topic to a very busy one. It's a crowded marketplace. There's an awful lot of initiatives. There's an awful lot of different networks. There's an awful lot of discussions, which are very hard to keep abreast of. And while the Sustainable Banking Network has been a brilliant way to stay in contact with peers in different countries, facing the same issues but at different stages of progression with different local realities, we wanted to expand that concept to say, how do we make sure that you all as a network have a close handle on the different networks, the different initiatives? You all have probably struggled to keep abreast of what's going on in your own countries, but what's going on globally. There are principles going on impact, there are principles on responsibility, there are networks for insurers, there are networks for project finance, there are networks for all aspects of the financial system. The network for the greening the financial system will be meeting next week in Paris, and Ethiopians will be there representing us and you. That's a busy marketplace. It's an awful lot to keep a handle on. So the idea of this session is connecting the dots. How do we make sure we're not reinventing wheels? How do we make sure we're not duplicating efforts, running in parallel? And how do we make sure we are grabbing the opportunities for collaboration? And I have a wonderful panel here to help me in that conversation and to introduce you to some of the other key players in this space and to some of the other networks and what they're up to. Starting on my right, Simone is the banking team lead with UNEP Finance, which has been very, very busy. UNEP FI in recent years. They have 200 banks as their membership, as well as insurers across 60 countries. And they've been busy setting up some new principles for responsible banking, which Simone will tell us a little bit about. To her right, Klaus Prochaska, I'm going to pronounce this wrong, aren't I? Prochaska, thank you, Klaus, is the lead for financial inclusion and climate change at the Alliance for Financial Inclusion, which is a vibrant network he's going to tell us a little bit about and help us get to grips with where does green finance end and inclusive finance begin, and what are the complementarities. To his right is Alfonso Mora, a colleague of mine over at the bank in a group that cuts across the World Bank Group. He is the Global Director for the Finance, Competitive and Innovation Global Practice. His mandate is wide, covering stability and integrity, financial infrastructure, inclusion and access, long-term finance, and crisis and disaster risk management, and has a really relevant career background for all of us, having been a lead and a mission chief in several financial sector assessment programs, the FSAPs that are applied across your countries, and he currently represents the World Bank Group on the Financial Stability Board, the FSB. Last but definitely not least is my colleague here at IFC, Christian Rosenholm. I'm going to pronounce that wrong as well. I'll stick with Christian as I do normally. Christian is in our Economics and Development Department and has been a key architect in the recently launched impact principles. And he will be telling us a little bit about those, which are very complementary to the work that Simone will be introducing. So that's the lineup. The idea is to have a structured conversation. We've kicked off as usual with the more formal conversation with our governors. It's now We're getting back to the working level. We're rolling up our sleeves, and this is intended to be a conversation with you all. So I'm going to strictly police the team to no more than 10 minutes each. Some of them have slides, some of them don't. But then I really do want it to be a conversation with you. If we are going to really grasp the nettle of what the Sustainable Banking Network can achieve, we need to be aware of these different initiatives and having a sense of where we can collaborate and coordinate. So I'm looking to you to spark those ideas and connect those dots. I'm going to ask each of them, the mandate for each of them, which I'll expect you to help me keep them honest on, is to give a sense of what is the key strategic focus for your institution or your network, who are your members, so you can get a sense of who they're working with, and how that coordinates with this membership. What are the top 2 challenges and opportunities that you're currently tackling, and how? And what do you think we need to do collectively at the global level? This is the great challenge. The issues we're facing for sustainable finance, the clock is ticking. There really is time for anything less than an optimal global response. So how do we achieve that collective global response? And we're looking to them to spark some of those ideas. So without further ado, I'm going to hand over the reins to Klaus to kick us off. Klaus, thank you for joining us.
Thank you, Jamie. So to illustrate the perspective of the Alliance of Financial Inclusion, I would like to start with a short story. Last month, we visited the Central Bank of France to discuss our research on inclusive green finance. Now, it's no coincidence that we talked to the Central Bank of France. They are a global leader on green finance, but generally, the government of France has displayed great leadership in climate action. However, when France issued a policy to reduce their carbon emission, that policy was responded with violent protests on the street. And these protests erupted because the bottom of the pyramid, poor people, had the sense that the onus, the burden of this policy was unduly falling on their shoulders. So if we learn one thing from France's experience, it is that climate action cannot ignore the needs of the bottom of the pyramid. AFI is a network of financial sector regulators and policymakers in over 90 countries. Our members are in developing and emerging economies. We know that climate change disproportionately affects developing countries. And we also know that within developing countries, again, it's the poor, it's women that have to bear the brunt. We also see an increasing body of evidence that financial inclusion actually builds resilience of people against economic shocks, such as climate impacts. And we also see that financial services have become a way to include the bottom of the pyramid into mitigation efforts. A good example of that would be pay-go solar utilities that are very popular in Africa, but also in Bangladesh, and improve people's lives while including people into mitigation efforts. So a lot of great work already has been done in the space of green finance, but most of this work has focused on capital markets and big project finance. What AFI is interested in is financial sector policy and regulation that targets individuals and SMEs and tries to either bring them into mitigation efforts, but also to build their resilience and adaptation to climate impacts. So we've done some research in 20 countries, evenly spread out across the globe. And I'd like to share some initial findings. We will publish the report this month. So this is about to be published. The first finding is that we see that 75% of our sample has linked financial inclusion and climate change in a national financial sector strategy. And we see that in a variety of strategies. So, for example, Fiji National Financial Inclusion Strategy, Microfinance Action Plan in Jordan, Sustainable Banking Principles in Nigeria, Egypt plans a National Financial Inclusion Strategy that will have a pillar of climate change. So then, of course, the Sustainable Finance Roadmaps that we talked about before. But our members also have enacted policies to put this link between climate change and financial inclusion into practice. We find it useful to categorize these policies into 4 broad categories. That's provision, promotion, protection, and prevention. What all policies under those 4 categories have in common is that they catalyze financial services from the private sector for climate action, or provide climate finance through existing financial sector infrastructure. I also would like to say that the policies under these 4 Ps are a way to implement the Article 1.2c of Paris Agreement, which stipulates to align finance flows with adaptation and mitigation. So let me just give you a few examples of these 4 P policies. Under provision, we see lending quotas in Fiji and Bangladesh, refinancing facilities, Pakistan, Nepal, Bangladesh, for renewable energy, but we also saw refinancing facilities for reconstruction after hit Vanuatu. So those things can be used for 2 different purposes. The promotion bucket is more hands-off. For example, moral suasion. The Central Bank of the Philippines said, we don't want to get involved in any kind of mandatory policy making, but we signal to the market that green lending is a public good, and we expect them to act upon it. It doesn't stop there. Central Bank of Philippines, but also Morocco and Thailand do capacity building. Collecting data and publishing it back to the private sector is also a great tool to establish a benchmark that then banks can measure themselves against. Bangladesh does that in their quarterly Green Finance Bulletin. Under the protection bucket, we see various forms of climate risk insurance. We heard from Nigeria before, index insurance, but also Armenia, agricultural insurance. G2P, government to people transfers via mobile money, have been a way to provide social protection payments after disaster struck. And we saw that in the Philippines, but also in Fiji. It's a way to act more quickly, more targeted, and more efficiently. And credit guarantees are something also we've heard in Nigeria, a great example that can be done to protect lenders and also the credit portfolio. Lastly, the prevention bucket is environmental risk management. I don't need to explain this to anybody here. So let me conclude by answering a couple of your questions, and that was what should we achieve collectively and what are some partnership ideas? Going back to our research, I think collectively what needs to happen is financial regulators need to have a more systematic involvement in national climate strategies. 50% of our sample, in 50% of our sample, regulators weren't involved at all. And in the rest, they had an ad hoc involvement, but there's no systematic involvement. So I think this is a message to everyone in this room, but it's also a message to the traditional climate change stakeholders, if you will. So that would be number one collectively. The other thing, and we've heard that before, is data. I think there's no stakeholder that we discussed that is not interested in figuring out how to measure impact. What are the indicators? How can we get to seeing what works and what doesn't? I'm happy to announce that last week our data working group, AFI's data working group, created a subgroup on green finance, and this is an invitation for all, but also NGFS and others to work together on this, because we want to know the same thing, right? Let me finish by saying that we also have subgroups in our SME finance working group on green finance now. So whoever works on this topic, please come. We'd like to collaborate. And financial inclusion strategy working group. They also created a subgroup on green finance. Would like to collaborate with stakeholders. So we're open for business and would love to have your participation there. Thank you very much.
Klaus, thank you. That's fantastic insight into a network. I should have said in terms of the structuring of this session, I'm going to follow up each speaker with a couple of questions, and we'll get through all four before we then open it up to the floor. So please do note down your questions to everyone once we've heard from each of the speakers. But a couple of quick reactions, Klaus. I mean, a fantastic and vivid description of the yellow jackets in France. We've all been aware of these, and it speaks to the reality of climate response in particular, which is we're not talking the scale of the global economic transition is massive, and frankly, it's a dislocation that is going to create a lot of challenges and frictions, and we're all good at thinking about the sort of the positive moves, but the challenges of unwinding aspects of the economy that are not sustainable are going to be really challenging. And if we're not managing the environment, social governance risks and managing the inclusion, it won't be politically viable. So I thought that was a great way to start. A couple of quick questions for you. One is on the evolution, sort of stepping back to the governance of how you make a network productive and effective over the long haul. I thought it would be interesting for the SBN members to hear a little bit about, just briefly about the evolution of AFI and how it's gone about that. And the second is, this group has, in the last years, really benefited from some brave efforts on a progress report in which they've collectively agreed metrics of progress and scored their own progress candidly as a way to learn from each other and to track their own progress. I wonder, your publication sounds exciting, but are there aspects of that in there as well, or are you taking a different approach?
Okay. So on the evolution, AFI actually was started by a grant from the Bill and Melinda Gates Foundation. And our original and still our mandate is to advance financial inclusion policy through peer learning. So initially, we were administered by the GIZ, the German corporation, and we were housed in a project office in Thailand. But as we grew, and it was incredibly successful, and we grew to over 100 members in more than 90 countries, the idea was to become independent. And that thought was already in the initial proposal. So we never were supposed to be a project in all eternity, but the idea was built in to become independent. And so then we tendered to our members who wants to house us. And so this was a competitive process. Daniel will remember, he was the chair of our board back then. And so we ended up in Malaysia. Bank Negara Malaysia won, and we constituted ourselves as an international organization under Malaysian law. Right now, we are, I think it's more than 30% funded by member fees. So I think this is shows the attractiveness of the AFI model to its members. They are willing to pay to be part of it. And, but we also are open for donor funding, and many donors support us, which again shows the value proposition of AFI to donors. Something that is carried by their members is important for donors to support. So that is on the history and evolution of AFI. Your second question was with regards to progress, right? Progress.
Yes. And your report that you're about to publish, how do your members look at that progress?
Look, the work on inclusive green finance is now, we've done this for half a year. So this is very new for us.
Yep.
So we see this report actually as a starting point. This is baseline. It's a state of practice report. This is the policies that we are seeing in our network, and that's it. Next year, in 2 years, maybe ask me again about progress. At this point, barely starting, and I mean, we're proud that we collected this policy menu, if you will, but it's a little too early to talk about progress in this specific area.
Yeah. Klaus, thank you. Alfonso, if I can turn now to you, and maybe you could give us a sense of an overview of the bank's touch points in this space.
Okay, thank you, Jamie. Thank you, and thank you, Ron, for inviting me to this panel and to this event. It's very exciting. So let me try to summarize in three main aspects, no? Because the conversation on green finance is super big, no? as we know, and it's super broad. And one of the difficult things is actually to focus, and probably one of the problems that we have in the network, let me call it network as people working on this topic, is how we can actually focus on what really what really matters to increase our impact, no? Which is not easy. So if I will have to summarize what the bank does, there are three main issues. There are the three of them completely interrelated, and I will explain why. One is creating instruments, in a way, so helping countries to create instruments to deal with green finance. The main one is the green bonds. No? The bank, IBRD, has issued 150 green bonds in 19 currencies, more than $10 billion. It's very active on this, no? Which is good because it's a way of now we actually help Malaysia to do a green sukuk as well. We have done a blue bond, SDG bond, which is fine, but actually this is one of the takeaways of all this activity to me is we need to create an asset class. And we are doing so many different things with the same label, but with so many different configurations that this is everything except an asset class. And this is a big problem, because when you go to the second point of what the bank is doing, which is, let's say, regulation, standards, guidelines, you need an asset class in order to be impactful on this. Because otherwise you cannot modify the regulation. Because what are you really regulating? What are you really trying to incorporate on your regulatory framework? What are the characteristics of these instruments that you are defining, that you are using? And therefore, how can you streamline these instruments to be adopted into a regulatory framework, which is a big challenge. Because, as I said before, the span of instruments is amazing, no? And very heterogeneous. But the second thing, therefore, in which we work is on regulation and establishing standards. You know that the environmental safeguards and governance factors that are embedded in all the operations that the IFC and also the World Bank does is a way of trying to incorporate all these ideas or this thinking into the day-to-day of our client countries. No? But yesterday we had a very good BBL, and actually part of the people that were yesterday in the BBL are also here today. And we discussed one thing with the Dutch central bank that was quite interesting. They have done a fantastic job with a new report on risks and how to incorporate it into the risk management tools, no? Which is fine, but we still don't know how to translate this into regulation. Because actually we don't know if it is the regulatory framework, the one that matters, from a financial sector perspective. And let me explain this. When we think about regulatory framework, from the banking sector, we think about risks, we have operational risk, we have market risk, we have credit risk. The risk that we are talking about here is none of this, and all of them at the same time. But it's something that is really a systemic risk. It's something that you are not taking this risk because you are investing here or there, because actually the impact will not be necessarily in your balance sheet, that also in your balance sheet. But what matters is the externality, is the impact that will have in the whole economy or in the whole system. How do we internalize this risk? We don't have any clue. Because the regulation is not designed to internalize risks that are not idiosyncratic to my balance sheet, to my specific operation. And therefore, if I invest in a company that is contaminating or that does not comply with whatever criteria, with whatever guidelines, it does not necessarily have an impact on my balance sheet, on my P&L, on my dividends, on my shareholders directly. It will have, at the end of the day. It's a responsible thing. But it is not directly linked to my specific transaction, to my specific investment. And therefore, the regulation is not designed in a way that can tackle this type of problems. And that's why in the international fora, the discussion is, should we actually approach this with regulation, or is actually more related to incentives, subsidies, policies, etc., but not the hardcore regulation of the banking or the financial sector, no? Which is a question that I would like to send in to all of you, because I think to me it's a fascinating debate. No? How do we really incorporate it into the regulatory framework? And imagine that we decide, yes, is it a macro policy issue? Is it a micro prudential issue? Is it a stress test issue? I mean, how do you incorporate all this into your thinking? No? And Daniel, as a former superintendent in Peru, I'm sure that he has thought about it many times. No? So this is the second point that I wanted to mention. No? And as I said, it is important, the interrelation between the first one and the second one, because you cannot regulate anything if you don't have clarity on what is the asset that you are really regulating. No? And we are talking about assets, because at the end of the day, financial sector, what they do is to transact assets. So we package things into assets, and therefore we need to have a clear definition of the asset and an homogeneous definition of the asset to be able to regulate what we are actually transacting. No? And here, so this second bucket of things that the World Bank does, so since it is not easy, and that's why the network of greening the financial sector is trying to see, guys, how do we move from guidelines to regulation or to supervision? Because guidelines is fine, and we can launch guidelines and papers and books and books of guidelines, which is fantastic. But guidelines are not enforced. You cannot have you cannot enforce a guideline. You can propose, you can use guidelines, but you cannot enforce them. To enforce them, you need either clear tax incentives or regulatory incentives, no? Binary, in a way, incentives. And then the third point that the bank is also doing is related with data, which you mentioned before, Klaus, and I think is absolutely key. And again, absolutely interrelated with the first one and the second point. Because without data, it is impossible to regulate, because you don't know what you are regulating. And actually, you don't have a clear sense of what is the size of the market that you are regulating. And you can't really have a clear impact on the first point, so on designing instruments, if you don't have a good database of what you are actually trying to, the instrument that you are trying to define. No? And here I think that the World Bank Group, IFC, World Bank, we have, in my opinion, a huge role to play, because this is a public good. This is something that only institutions that can really generate public goods can really provide to the market. And again, it's a question that should start, and Christian will talk about it now. No? When we discuss the impact investment report that the IFC has just published, I was very lucky because I was peer reviewer of that report. No? And we have a long discussion on the definition. No? But because at the end of the day, the definition is everything else that you actually want to do with this. No? So when we talk about data, again, data, what data? What is the database? Yes, because monitoring and evaluation and knowing what is the impact that we are having, etc., this is fantastic, but this is the outcome. This is what you will do when you have the data. But the problem is that we still don't agree what is the data that we need to have, or we don't have clarity on what is the data that we need to have. So here at the bank, what we are trying to do is at least to have a good database of ESG sovereign data. So basically, to have a good database of what are the issuance, both on bonds, on capital markets, but also on lending, on loans, that actually comply with the ESG framework that the World Bank uses, which I believe is a good source of information for many other things, but it will not be enough. So we need to think more, and I like it very much, your suggestion, Klaus. We need to bring the different, and the Sustainable Banking Network can play definitely that role, no? Which is bringing together the different parts to actually decide or think what is the data that actually is needed, and to assign responsibilities according to what are the comparative advantages of each of the institutions. No? So I stop here because you gave me 10 minutes, and I think I have done 10 minutes. So thank you.
You did great, Alfonso. Thank you very much. You opened in a place that I keep coming back to, which is in this space. It's so. The implications are so wide. How do you stay focused and move the ball forward while staying connected? And this panel's very much about that. And we in the bank group end up having some very and this will, I'm sure, will resonate with you as banking associations and banking regulators, that the shift to sustainability is forcing us all to have some very unusual conversations. So, it's the first time we started saying, well, in the green bond space, we're an important issuer. The bank and IFC are some of the biggest early issuers of green bonds. We're now a big buyer. I see my colleague over there, Jean-Marie Masse, who's helping structure a large fund with Amundi of France to buy bank-issued green bonds in emerging markets. We're on the standard-setting part of the world, and we're clearly operating through networks in some of the policy zones. And so having these conversations saying, actually, all of these activities need to be joined up are triggering some very interesting conversations. I wanted to come back to that where you ended, Alfonso, on data. And it is fascinating because as the green bond space opens up to a significant amount of sovereign issuers, it's attracting buyers who are asking new questions, particularly around ESG risk management. And they care. They want the impact and they want the risks managed. And the bank, if anyone is aggregating data on sovereigns and ESG aspects, it's the bank. My first question for you is on how you're going to package that up. Your historic consumers of that have been countries, sovereigns themselves. Now it's trading floors. It's a different consumer and a different way, type of need for that data. And my second question for you relates to this network's recent progress report. And my read of it was on climate response was interesting, and maybe I'm sure everyone's read it differently. But my take was an awful lot of the membership is asking of their banks to have climate strategies, but there seems to be a challenge in going to the next step. And it occurs to me that you ask, under sort of thinking about transition risk and physical risk for banks, you ask them to do that. Underlying that is a desperate need for macro data. Before a bank in, the Philippines can say, I'm exposed to this much agri and this much fisheries and this much, and this is the implication for me, you need a sense of what is climate going to do to my region and to those sectors for me to then take a view on my portfolio level risk. And I wonder if you've got any thoughts on how the bank can help in that space as well. So two questions for you.
Well, the second one is quite of an impossible question, but I will try. So on the first one,
I didn't say it was going to be easy.
So the briefing that actually my team gave me, there was one fact that I was amazed. No? 1/3 of the global assets under management claim to be managed under some form of sustainability, responsibility, ESG framework. 1/3 of the global assets. Come on, this is a joke. I mean, but we haven't seen any capital flow. So we haven't seen any relevant change on the capital flows. But 1/3, they actually say that they comply with some sort of sustainability. The thing is the definition of all this. No? I mean, what do you mean by sustainable or responsible or ESG framework? No? Each of them have a completely different definition or may have a completely different definition, and that's why 1/3 claim that actually they comply with something. We don't know with what, but they comply with something. But actually you don't see the impact on the capital flow. So therefore we are not there. No? So coming to your point, what is the comparative advantage that the World Bank could have? Precisely this database. So these ESG factors and the work that we have done on sovereign, because this is where we have the clear link with countries, and this is what we are trying to bring together, no? This database. Hopefully we will. This started with an interesting knowledge piece that we did with the Japanese pension fund, which is the largest pension fund in the world. No? And actually what they asked us was, how can we incorporate the ESG factors in the fixed income market, which is probably easier than into the banking regulation. No? And actually we did a nice report on how these ESG factors matters in terms of returns, in terms of impact, etc., on the fixed income market. No? And then on the next steps, one of the main problems was we don't have the data in order to do a really good and comprehensive analysis. No? And that's why we ended up saying, okay, let's focus on the sovereign fixed income market and use the ESG data that we may have to strengthen the results. So this is what we are supposed to do. On the second, or we are committed to do. On the second question, I don't know. I mean, I don't, since my question is even beyond what you were mentioning, Jamie, because to me it is not that, okay, I am, imagine, BBVA, and I operate in almost all Latin America, Spain, Turkey, I don't know how many other countries in the world. No? I don't really need to know what is the impact that climate will have in each of the markets that I operate and in each of the sectors that I operate in order to take action or to take decisions. Because it is not a question of the specific impact that it's going to have in a specific country or in a specific region. We know that everything is absolutely interrelated and is not idiosyncratic. And this is the problem of this risk. There is not an idiosyncratic risk that actually affects only one specific sector or one specific region.
It's everything.
And that's why it is very difficult to measure, and it is very difficult to incorporate in any regulatory framework. Because at the end of the day, what we are trying to do, and now we are trying to do some pilot exercises in the FSAPs, no? With incorporating green finance. But you know that the FSAP is an assessment that is based on, or is most related to regulation. We don't have any regulations here. So we are focusing on disclaimers, disclosures more than disclaimers. And the disclosure is what we think can actually, or what we think that can actually have an impact. No? So because of the reputational risk that this disclosure have. When you mention the strategies that banks need to have in terms of climate responsibility or whatever, that's fine. I can have whatever strategy, but so what? I mean, is there anybody that is going to come to me and say, yeah, you didn't comply with your strategy? No, nobody's going to tell me anything. Or I can do a super nice marketing announcement of the strategy that I have on climate, no? Which is fine, it's free. So there is no commitment and there is nothing that actually precludes you to do that. No? The important thing is when you actually try, or when you see that there is a clear relation between what you are defining and the results that you are providing. No? And there is where I think that we have a huge challenge, and it is absolutely difficult to implement. No? Because again, you don't have the regulation, and therefore all the strategy is just a question of, is more volatile in a way. And second, because it is not easy to I would say, have a nice benchmarking, which is something that also matters a lot. And this is related again to my first point, my second point, and my third point. No? At the end of the day, both private and public sectors, we work with benchmarks. We want to be better than the others. This is a competitive market, and this is what we want. So, and to have a benchmark, you need to have something that allows you to compare equals. No? And this is the challenge, coming back to my initial point, which is the data.
Thank you, Alfonso. I'm guessing there'll be some more questions from the room around your FSAP pilots, but we'll leave that to build in the group and shift to Simone. Could you tell us a little bit about what the UNEP FI's membership and what you've been up to recently?
Absolutely. Thank you very much.
I think that you need.
Yep, I do have that. I think we need to go to the beginning. Perfect. Wonderful. Yeah. Thank you very much. UNEP FI, we represent the other side, the banks, insurers, and regulate. Some of you represent the associations here in the room. Many of you know us. For those who don't, UNEP FI, the UN Environment Finance Initiative, it's the partnership between the United Nations and the global financial sector. So our partnership with about 250 banks, insurers, and investors from over 60 countries globally. That makes this really the largest private sustainable finance initiative and also the oldest. Since 26 years now, the private financial sector in and through UNEP FI has really been shaping and driving its sustainable finance agenda, with standards that many of you might be aware of, such as the Principles for Responsible Investment, the PRI, the Principles for Sustainable Insurance, and also the banking industry is really setting out its vision now. I think you ask very much for our strategic focus, and I think it's quite simple. It's really helping banks to be a driver and a positive driver for sustainable development in their countries and worldwide by creating value for both their shareholders and for society. And really what our banking members especially, and there's about 150 of them worldwide, felt in the last couple of years that the world is changing. There are major challenges in terms of climate change, in terms of sustainable development, in terms of planetary boundaries. And at the same time, there are major changes in society, especially also in Western societies, and what new generations want and seek, etc. And there is more and more demand for the banking sector specifically to be playing and showing a leading role and contribution in society. And so what our banks felt was really key and needed was for the banking industry to put forward very clearly what the global banking industry's vision is in, about its role and purpose in the future, what its contribution to society will be, also in putting forward a global standard for what does it actually mean to be a responsible bank, and having guidance for banks worldwide in defining their purpose, in defining a strategy to implement that purpose, and in having practical guidance and peer learning and support in doing so. That is one of the main flagship projects, and that's the one I will go into detail on. More broadly, of course, UNEP-FI works with its members in setting the agenda, where do we need to go next in terms of sustainable finance, in peer learning, in having joint working groups, working with external experts, really advancing the tools and instruments that financial institutions have at their hands and the good practices to advance on sustainable finance. Of course, there is training, there is capacity building, there is guidance. But there is also a lot of interaction between us and regulators worldwide, because what we get a lot is regulators also wanting to see where do banks stand, where are they heading, how can we collaborate with the financial sector on these issues. So I'll spend a little bit of time with regards to this vision that the banking sector has set out. Why did I choose this one? Look, we really represent here the private financial sector. It's been very clear for banks, insurers, and investors that a transformation is needed of the financial sector. Transformation is needed for the banking sector very specifically to show its contribution to society, to find a very clear role in the future. And changing a system can never be done by any single actor in the system. And the other part of the banking system is all of you. There is the banking industry, but there is also the banking regulators. And I'm coming today presenting this vision that banks from around the world have set forth to enter into a dialogue with you. Because from our perspective, what is really needed is a joint vision, right? So we're very, very keen from you to hear from you what you think about, what these banks are putting forward. Does this go in the same direction? Is that your vision? I'm also very interested in hearing from the SBN as well as from AFI. Is it that every regulator in every country develops their own vision of the future of their banking industry? Is there work also together in these networks to develop a collective vision of where the banking industry should be headed, what role it should fulfill? Because for our banks, well, regulation is local, but the financial sector is global. And so guidance also from regulators on the vision, on the future, on the role of the banking industry is something our members will be quite interested in. So very interested to hear from the networks, but also from the people in the room today. So you might appreciate we have 150 member banks, and drafting something with 150 institutions is pretty much impossible. So the way this went is that we had a number of institutions, 28 from within our membership, volunteering to really take the lead in developing this on behalf of consultation with our broader membership. And you see it's a very diverse group. It's from really 5 continents, over 24 countries, different business models, different sizes, and jointly represent over $17 trillion in assets, so about 10% of the global banking industry. And what is the vision? What are the principles and commitments that these banks have set for themselves in terms of their purpose, their role, the way they want to do business in the future? There are 6 of them, and we start with alignment. And alignment is really this first principle that sets out the vision and objective here. And that's very clearly aligning banks with society's goals. That's really what they see for themselves. And that means making society's goals an integral part of their own strategic objectives, making it a part of their decision-making, of how they allocate their portfolio, of their business practices, and with that also, and I think that's quite key, elevating these topics of responsibility, of sustainability, from a compliance, from checking transactions, really to the strategic level, making it part of the DNA, of the core purpose, of the raison d'être of the bank. And how do our banks see themselves achieving this? And that brings us to principle 2 on impact. Because for banks to really increase and show their contribution to society, they first need to understand their social, their environmental, and their economic impact. And this principle is quite a significant change in viewpoint. For many years, we've been talking a lot about risk. And I know that's at the heart, of course, also for you as financial regulators. But this is no longer just about what impact do developments in the world, does climate change have on my portfolio and my risk? This is about what impact does my portfolio as a bank have on the world? And so our banks commit to assessing and being transparent about their impacts, both positive and negative, and to work to continuously reduce their negative impacts while scaling up their positive impacts. And how do banks do that? And I think here is really a core of the power of the banking industry, of its reach, and really of the uniqueness of its business model in the financial industry. It is through clients and customers, because really if you think about it, the vast majority of a bank's impacts is realized through the projects, the companies, the customers that they provide financing to. And so it is really through working with their clients and customers that banks can create their most significant positive impacts, through really proactively accompanying and encouraging their clients and customers in their transition towards more sustainable business models, towards more sustainable technologies and lifestyles, is really by developing a product and service offering to meet these upcoming needs of their clients and customers, to incentivize and enable a sustainable transformation of the real economy. And with that also for banks look to strengthen their relationships with their clients and customers and distinguish themselves and provide a value add to customers that they want to bank. And of course, while banks are very influential and powerful, there is only so much that they can do, that they can contribute in helping to achieve society's goals. And that's really what gets us to principle 4, stakeholders. And that's where all of you come in. Because of course, yes, banks need to work with civil society to really understand their impacts, to understand how they can improve their business practices, how they can contribute better to society's goals. But also, they need to and they want to work with regulators and policymakers to jointly create the enabling environment that is necessary for the economic and social changes that we need to tackle our greatest challenges. Of course, it's quite clear, principles 1 to 4, in order for those to be implemented really effectively and to align banks with society's goals, they need to be integrated in day-to-day business practice, in day-to-day decision-making. And that, of course, integration in policies, setting up clear roles and responsibilities. That means culture change, that means leadership communication, but it also needs a clear mechanism to drive ambition and to drive continuous progress. And that is public target setting. And that is really a unique feature of this framework that the banks are setting forth. Because if you think about it, through setting a public target, a bank commits itself externally to clear course of action, to clear ambition. But almost more importantly, it also does so internally. It does so internally, and with that really ensures accountability from top-level management to the working level. It ensures that these issues are given sufficient priority, that they're given sufficient resources. And it really triggers a drive to achieve and exceed what has been promised publicly. So all banks really commit to set targets, and not anywhere. And this is really also, I think, a quite important feature here. For a long time, we've seen, sustainability and maybe some positive impacts and more financing at the fringes for some good technologies, etc. But I think in order to really make a dent in the challenges we're facing, banks need to focus their efforts where it matters most, where they can have the most significant impact. So when we're talking about target setting here, banks commit to be setting those targets in the areas where they have or can have the most significant impact. And they also commit to, not set their own arbitrary ambition levels, but to very clearly link to external frameworks. And I've been speaking about society's goals, and when we speak about society's goals, that's at international level defined in the Sustainable Development Goals and the Paris Climate Agreement, and of course also at national level in national policies. So banks commit to set targets that clearly align them with society's goals as set out in these frameworks. And of course, target setting is fantastic for driving ambition. It is equally great for driving transparency and accountability. Because banks understand that they're not just accountable to shareholders. They are accountable also to employee and society, and they want to be accountable to them and be transparent. And they commit to be transparent about their positive and negative impacts.
You're good, but I'm going to cut you short pretty soon because I'm...
Absolutely. So I won't give you a summary of the key features, but we're talking here about connecting the dots and collaborating. I think this is what the global banking industry is setting out, and what will be launched on 22nd September in New York at UN headquarters. But really, the banking industry is one part of the banking system. So what we really need is for you to get involved. To get involved, to provide your feedback and inputs on this vision, maybe to provide your own vision in contrast to what you're seeing here. And we are in a global public consultation. These principles are currently out as draft. It goes until 31st of May. So we're very excited to hear from you today, but we're also very excited to hear from you in 8 weeks via our website or if you get in touch with us. Thank you.
Simone, thank you. Exciting initiative. I'm going to leave you with a couple of questions, but I'm not going to ask you to answer them because our next speaker, Christian, has a very complimentary initiative being led here at the IFC targeting a slightly different stakeholder group. And I'm going to ask you both the same question. So you can hold on to it for a little bit, and then I'll come back to you both for that question. And then I do want to make sure we've got time to open it up to the floor. So, Christian, I'm afraid I'm going to ask you to be relatively tight on your comments. My question is first one is one that will, I think, resonate in the group here, which is, as banking associations, as banking regulators, or as a global association of effectively front runners, how do you make sure that you move the whole? How do you bring everyone along? It's a sort of theory of change question. And the second is where we started this conversation with Klaus, which is balancing the impacts and the risks, and how do you make sure you balance those? And that's very much at the heart of all of the SBN membership's ambitions. So, Christian, over to you.
Thanks a lot. Can I?
Yes, of course.
Borrow that one? Thank you. So I want to start in a little bit different place. I'm not going to talk about IFC strategy, but on this one initiative that we have around impact investing. So the key thing is that we see, and the impact investing is focusing on asset owners, asset allocators, and asset managers. We are an investor, so we're part of that community, heavily engaged in emerging market, as you know. But what we've seen is there is a shift. So we can talk about regulations and we can talk about standards, but what is really driving currently the international investing market is very much that the customers is demanding a change. They're asking for a change. They don't just want to have financial returns. They also want their investments to do good. And we see that change, especially within Generation X and millenniums, if you like. And in the US, over the next 5-10 years, there will be a transfer of around 30 trillion of assets to that from the baby boomers to this generation, and they want more. We also see this trend in within women preferences in their investments. They also want more than just financial returns. I'm sad to say that the segment that I represent is the hesitant ones. So the middle-aged man is still very, very conservative when they look upon their investments. Although I heard from a number of European banks that they are seeing a preference change in this segment as well. So there is a major push to the financial industry to change some of their ways of how they do business. We've seen that and had a number of discussions with colleagues in the field on this impact investing. There's a lot of talk about it. But what is it and how do you actually then do this in a good way? And in response to that, we went back and said, how can we help move that market? How can we help create a market where we are both getting financial returns and we are also contributing to solutions. We're contributing to the achieving of the SDGs. How do we do this? And there's quite a lot of confusion. Some call it the alphabet soup out there. There's a lot of things. So we start gathering a group of asset owners, allocators, and managers with many years of experience to say, can we find some commonalities here that can help us in doing this? Is there actually a market? Is this interesting? Is there a potential for actually providing a significant contribution? Is there something to engage in? And we just launched a report here on Monday at the Brookings on what we call Creating Impact, the Promise of Impact Investing, where we try to have a look at, can this really play a significant role? And the conclusion is very simple. Yes, there is great potential out there, both in the private market. It's about 5 trillion, what we're estimating that could be allocated for doing good as well as financial return. The public market is where the really big numbers are. It's about 21 trillion that could actually go in this way. But there are a number of obstacles. There are a number of barriers to get to that. So one of the things is, what the hell is impact investing, sustainable investing, responsible investing? There is a number of things out there. So what is this? So some kind of clarity of concept is needed, an understanding of that. And I think you alluded to that as well, Jamie, and you did as too, Alfonso. So what we've done is, and I'm repeating this, that it is impact alongside financial returns, because those numbers that I just gave will only be achievable if we provide market-level risk-adjusted returns. If it's sub-commercial, we will never get to those numbers. But what are then the other attributes? So we talk about intent. Simone, you talked about alignment, but we talk about intent. We come at this from the investor's point of view. So you need to have an intent. A lot of impact happens by chance. It's fantastic, but then you're not managing for it. So intent is really, really important to have that up front. The other thing is, are you actually making a difference with your money? Or are you just recirculating financing? So if you want to look at impact investing, you need to also be able to have a credible narrative around how do I make a difference in the way I do my business, in the way I engage with my investees. It's easier in the private market, very much easier. In the public market, we see an expansion of active shareholderism, and that's a possibility. It's much more difficult, but we do see trends within the green bonds markets. That's a much more clear pathway of contributing. So that's really interesting. And then I was very happy this morning to hear a lot about measurability and to measure. Because if we have intent, we are also contributing, but we don't know if we are successful or not, and how and where, then how are we going to learn, and how are we going to improve, and how are we going to communicate? So those three attributes, intention, contribution, and measurability is needed. Then the next question comes to mind is, but how do we do this? And how do we get to impact? And this is where we on Friday will launch what we call operating principles for impact management. So to look at, again, synergies with what Simone was talking about when talking about management, we try to get a step deeper to say, if we want to have impact alongside financial returns, what are the decision points that we need to follow alongside financial returns? So we go from having the intent, so we might have a financial target, let's also have an impact target. We manage our financials at a portfolio level. You can do that for impact as well. You don't necessarily have, all projects don't deliver the same level of impact. All projects do not deliver the same financial returns. So following the logic of how we manage for financing, or financial returns, how do you manage for impact? Over to origination and structuring, where also following the same logic are very clearly saying, so how will we contribute? This is the contribution. What difference are we making? That needs based on evidence a lot. Where we can, we know that going into, and this is where we get to the difference maybe between sustainable investing and impact investing. So both assessing ex ante what is the potential for impact, and the other principle that you need to is look at how do you mitigate potential negative impacts. Again, very much aligned also with what Simone was talking about, both the positive and the negative. To relate that to ESG, the way we look at this is the ESG benefit is great impacts. So there is not a conflict on that, but of course then you also have the risk mitigation parts of the ESG, and that's about the negative impacts. So very good alignment there. It depends on your intention, whether it's a side product or whether that's your focus with your investment. And then, of course, to portfolio manage, you need to keep track. You need to continuously learn, are we on track, just as you would for financial return. And if you're not on track for impact, what is the appropriate actions that I can take to make sure that we get there? And then, of course, at exit, which is difficult, is when we talk about impact at exit, which is very much private equity terminology, but we're using this because we lack a better word. It is where you make an active decision to exit an investment. So if your loan just runs out, that's not what we're talking about. But if you make an active decision to exit, consider the sustainability, the duration of your impact. Is there anything you can do to make sure that the impact you have achieved will stay there and remain there? Then, of course, there is also having a look at how can we learn from what we've done so we can continuously improve and renew and document what we do. So that's the last part of it. All of this needs, of course, especially on the exit, needs to be aligned with our fiduciary responsibilities. One of the points that we're making in the report just launched is that it's been a very, very narrow definition of what is fiduciary responsibility, and we're pushing for that to open up much more, to go financial returns. As long as it's agreed with the beneficiaries, you could take non-financial considerations into your fiduciary responsibility, and that might be something for you to consider and discuss. So this is what we're launching. The last part, which relates very much to what was talked about this morning, is transparency. So that's the last part we're saying is, if you want to label your investments as for impact, you also need to be able to disclose a report that you actually have these systems and processes in place, and at periodic time, depending on the complexity of your engagement, have that verified, that you are actually doing it. It's not just a show and dance and you sign it and you put it on the shelf. You actually get that verified and you publish this. So people can actually start knowing, are you following the principles? This will lead, we think, to some more discipline around this. It will also lead us and help us in making choices so we can start comparing. So who is actually having robust impact management systems and who might not have, so we can decide where we want to put our money and who we want to be engaged with our financing and our pension savings. I'll stop there.
Christian, thank you very much. I'm conscious of time, so rather than asking my questions, I want to make sure that everyone in the room has an opportunity to ask questions. There are mics on your tables, so please, why don't you kick us off here?
This is Milad from the Central Bank of Bangladesh. I have questions, firstly, for the AFI personalities. Very good discussion. Thank you so much. My first question is that, has AFI has a vision to link green finance with a sustainable finance in a structured manner? The second question is that there are green financing in SME, there are green financing in agriculture, there is green financing in corporate financing. So how this could be together to address that the green finance should not only for the green finance, because a bank, it is not like, or a financial institution, it's not like Her Excellency of Mother Teresa or the Her Excellency Queen Elizabeth II, but it is like that banks and financial institutions need to be sustainable on their own, but they will go for green investment, they will go for the sustainable financing, as well as they need to be sustainable within themselves. So for that, how banks and financial institutions could be structured in that manner that they will invest in green finance, as well as those green finance would be a sustainable one, because green finance not necessarily be sustainable. But it is the priority to address the environment. But from the banks and financial institutions' perspective, those investments need to be green as well as sustainable, because there should be a vision up to 2041 that all green finances should be a sustainable one. That should be the ultimate goal. So that is the question and how AFI is thinking on that. as AFI is thinking on making a group, a principal group for green financing. Not that the SME financing, they have got the green financing. Not that the digital financial service, they are the green financing. Not that. There should be a dedicated green finance group that can incorporate all these issues, and that is one indication that I must recollect that Bangladesh Bank's governor, ex-governor, they have made an approach to Alfred that there should be a principal group on green financing, but I don't know what is the outcome. So this is number one. And for World Bank IFC groups, to all or everybody, a question is that you talk about the environmental and social risk management guidelines that should be sustainably with respect to credit appraising. But credit appraisal is not enough to make a business deal or a project sustainable. Because nowadays, environmental and social risks assessed in such a manner, and they should be incorporated in the credit risk management. So environmental and social risk and credit risk, they need to go together in the overall rating to make the business or project deal a sustainable one. So what is your attitude towards the central bankers, the regulators, and how could you pursue to that to make that outcome effective? So, and the last questions to you may
cut you short. You get two.
Okay.
I'm gonna
Okay. Sorry.
Klaus, while you're having a think about inclusion effectively at the sector-by-sector level with green finance and making sure it's financially sustainable for the banks too, you've got a question also for Alfonso and Christian around integrating risk effectively at an operational level. I'm going to just collect a couple questions, and then we'll go back to the panelists while they're okay. Remember my rule, I just created it. That's the problem with dictatorship. You can come up with new rules at any moment. So over to you. Let's turn this on for you. There you go.
My question is to Simon. Just looking at the newly launched sustainable or responsible banking principles, and knowing that various members of the SBN have or are about to develop their own national policies. So how do you align, these global principles together with the national principle that is being implemented at country level? I know because your members are banks, but like for us, the banks are members of they implement that, but what about the regulators or banking associations that are also implemented in other countries?
Good, great question, thank you. And this is the collective challenge, right? And we've got one other commercial banker in the room as well, but this conversation needs to keep coming. I'm going to collect two more questions and then we'll go back to the panelists.
My question is to Simone. She was talking about the 6 principles and looking at the area of impact on the climate. And one of the things she was talking about was how to remove the negative impact at the same time, trying to ensure that the positive impact will be ensured. And I wanted to know how they will measure it. Because if you are financing projects and you want to ensure that the positive impact will be realized, have we set some targets or tools which we will use to measure those impacts? Then we can know that as far as possible, we will be able to achieve our targets.
Great, Isaac, thank you. That's another one for Simone. And is there consistency in the targets, or do the banks just all get to make up their own, or how does that work? Final question, and then we'll go back to the panelists.
Actually, hello, my name is Isabel Mantilla, and I come from the National Banking Association in Colombia. And maybe more than a question, it's a comment.
Great, bring it on.
And also, talking to the gentleman from Bangladesh, I think here what we need, and I agree with UNEP-FI completely, we need a collaboration or a collaborative scenario more than anything, because private bankings can and will do things, but their strategies will have no impact if the government does not follow, and if we don't have that institutional security on the bottom. Yep. So we do need those regulations, and we do need all those laws to comply with, but also the incentives. And also, when you talk about sustainability and going that way, it's a new approach to business. So the first thing we need to take into account is that those deals, those projects, green, orange, red, whatever you want to name them, need to be profitable, first of all. And then we'll go from there, I guess.
Great, thank you. So I'm conscious of time, and you folks are between yourselves and everyone else and lunch. So I'm going to suggest that we hand back to the panel, and maybe we'll go in the order of how you spoke originally. So maybe, Klaus, if you could kick us off and just, again, repeat the question or the comment you're responding to and go from there. We'll hand off to Alfonso.
Yeah, so the question was from Bangladesh Bank, are we creating a working group on inclusive green finance, or just trying to make this a cross-cutting topic? And your comment could not be more timely. As always, AFI responds to member needs and demands. That's what we are. We are a member-driven network. And Bangladesh Bank has been actually the first institution to push for this topic to be adopted. And you're not the only one. So there have been several members that requested the creation of a working group, and we have put together a proposal to our board. The board, I think, will convene today, so I don't know what the decision of it will be, but it is subject to the decision of the board to create this working group. Since your governor chairs the board, I am mildly optimistic that it will happen, but I cannot preclude the outcomes of this session. So, tuned. I hope they will approve.
Thanks, Klaus. Alfonso, any reactions to some of the questions and comments?
I mean, very quickly to the comment of how do we incorporate the ESG risk into operations. So basically it's embedded in every operation that we do. So we have to comply. The countries have to comply with the specific ESG guidelines, I would say, in order to, it's binary. So either you comply and therefore we go ahead or not.
Thank you. Simone.
Okay, there are a couple of questions. I think on the national and international alignment, I think it is absolutely fantastic and crucial that there are conversations at national level about the specific role of the national banking industry. And if you look a bit into these principles, they allow a lot of context specificity by allowing banks to relate their targets to national frameworks and hence respond to national priorities and national context. One problem that our banks have a little bit with every jurisdiction having their own principles, their own reporting, etc., is a little bit that a large part of the financial sector isn't really limited to one jurisdiction. Many banks operate in many jurisdictions at once, and even if they don't operate in several jurisdictions, they might have shareholders and investors that come from somewhere else. So a different standard in every country becomes difficult from the perspective of our banks, and they are seeking, in a way, a global consensus that can definitely have national nuances. But if there is, I mean, that's why we have a financial stability board, right? Because financial regulators for a long time have realized that they need to move together, otherwise it won't work. And I mean, this is in a way very similar. This fragmentation becomes very difficult for the financial industry. And I give you one case. I mean, right now, at European level, they're developing a green taxonomy. And that is fantastic and tremendous. Yesterday, I was in New York and had quite a few Canadian banks in the room. And for them, this is a huge headache and problem. Now, Canada also has its own HLEG, its own working group that does its own taxonomy. Now, then they're going to come up with two different taxonomies, and I mean, there's a lot of financial relationships between European investors and Canadian banks, and it becomes a huge problem. So I think while every country has its own context, and every bank needs to, serve its own society, there needs to be a global standard that brings us together while allowing context specificity, because then again, the financial industry is global and just operates across jurisdictions. I don't know if you want to respond to that.
Yeah. Christian, any?
Yeah, just on I think it's a really good question of how do you balance the risk sides and the positive impacts in your investment decisions or in your decision making. What we do, and Jamie, you might jump in here as well, but what we're doing within IFC is very much that all our investments go through an assessment along IFC's performance standards, and they're all given an ESG risk score. What we've also do is, of course, that is part of a holistic decision making together with the potential positive impact that we might have, as well as the financial returns. So it is a balancing argument, but of course, if there is material risks, then that can be a no-go indication of that. But other than that, it is a balancing act. What we've done in the operation principles is that we've purposely said, let's not mix them all together so we can do a formula and they can balance out, because I really think that we need to consider each of them on their own merit and make a cross-cutting decision rather than pulling it all together. And that means that it might not be so transparent of what we do, because you're balancing a positive out with a negative, and I'm not in a position to make that value judgment all the time. So everything is looking at it from an ESG perspective as it on its own merit, together with the positive on its own merit.
Christian, thank you. I'm hoping we can persuade you all to stay for lunch. I'm sure there will be follow-up questions and conversations. I'm in our dash to transition financial markets to sustainability. I'm sort of always reminded of the Indian parable of the blind men touching the elephant and coming to very different conclusions as to whether they happen to be touching the tusks or the tail or the belly. And the original objective of this panel was to make sure that we're not only communicating amongst ourselves as a network across countries, between regulators and associations, to harmonize and learn from each other, but also widening our peripheral vision to all of the aspects of this transition, which all need to happen in a harmonious way, whether it's across markets, banking markets, capital markets, insurance markets, across countries, or across the dual needs to manage risk and build impact. And that's a really challenging thing for all of us in our day-to-day lives. And I'd like to thank the panelists very much indeed. Christian, Alfonso, Klaus, and Simone. The referenced initiative in Europe, actually, we'd hoped to bring you a colleague from the EC today, but they had a last-minute travel issue. But if you have thoughts on bits of the elephant that don't make sense that you're touching, and you'd like to include them in a panel next time, or in SBN communications on helping all of us get smarter on different aspects that are moving in parallel, do let us know, because we're keen to make sure that we all get to see and touch the whole elephant and move forward in an efficient way.